Long-term care. Long-term care is a variety of services to meet the medical and non-medical needs of people with chronic illness or disability. These services are designed to help people live independently and safely where they can no longer care for themselves. Long-term care statistics. 70% of people who reach 65 would need some type of long-term care, and 40% would need long-term care in a nursing home. The average period of long-term care for men is 2.2 years, for women is 3.7 years. The top 5 reasons for long-term care is Alzheimer, arthritis, cancer, stroke, and nervous system conditions. Long-term care service model. Informal. 70% receive care from family members, 51% live in their own home, and 29% with a family caregiver. Entire family chip in to help, and average about 20 hours a week. 60% are employed and 66% women. Formal. There are all types of formal care such as physicians, nurses, therapists, respite caregivers, and even money managers. Providing care can be very demanding. 1 in 10 family members report deterioration in health, but Medicare can cover up to 5 days of respite care at home. Long-term care costs. Home health care for a full-time nurse is about $150,000 a year. Part-time, 18 hours a week, is still about $20,000 a year. Nursing home for a semi-private room, it's over $100,000. And for assisted living, somebody who's a little bit more independent, it's about $50,000. Long-term care settings. Home care is most popular because of cost and convenience. Continuing care retirement community provides social life and long-term care but can be expensive. Local community service and adult care. Assisted living for those who need some level of personal care. Finally, nursing home and hospice for intensive end-of-life care. Funding for long-term care. There are different ways to fund for this very expensive expense. Self-funding through your own savings or reverse mortgage. Products such as long-term care insurance, life insurance, or annuities. Through government, that would be mostly Medicaid, but Medicare will also pay for some. Finally, family and charity. Family delivers 70% of all long-term care. Between 52 and 65 million people are involved with family-provided long-term care services. Represents over $375 billion of unpaid care services. 46% of the people receiving care are over 75, and 60% of the caregivers have other jobs. Long-term care insurance. Who is a typical buyer? The average age is 57 years old. Minimum assets is around $200,000 outside home, and the largest market for long-term care is actually wealthy clients. They are looking to shift the risk to insurance companies in order to protect assets. Long-term care insurance policy. There are 4 main decisions. How much risk do you want to insure? So what is the monthly, daily benefits you're looking to get? The elimination period, or wait period before getting paid. Max benefits in terms of total contract and max payouts per year. And lastly, inflation protection. How benefits are paid out? Reimbursement. The insurance company pays up to policy limits. Need to qualify expenses for payment. Indemnity. Once benefit is triggered, you get full monthly benefits regardless of expense. Reimbursement cash model. Certain percent, like a 30%, will be paid cash regardless of how you use it. The activities of daily living. Difficulty in performing 2 of the 6 activities is a trigger for benefits for long-term care insurance. Eating, toileting, mobility or transferring, bathing, dressing, and continence. Instrumental activities of daily living. Difficulty in performing these activities will have a direct impact on activities of daily living, ADLs. Grooming, walking, shopping, cooking, housekeeping, transportation, and taking medications. Types of long-term care policies. Qualified. Benefit trigger needs to be certified by professionals. Benefits are tax-free. Premiums deductible to a certain limit. Non-qualified. It's less restrictive trigger. Benefits tax is ordinary income, no deductibility. Share benefits between couples to defray premium. Government programs. If it's Medicare, it must be medically required. Medicaid is by far the most popular choice. Picks up close to 50% of all long-term care expenses, but you need to be qualified. Then there are programs from the state, Veteran Administration, PACE program, and the Older American Act. Long-term care insurance. Average period of need is 2.2 years for men and 3.7 for women. 70% of long-term care purchases buy a 3 to 5 year benefit period. When should you buy long-term care insurance? The average purchase age is 57. If you buy it later, you do get some savings, but that doesn't guarantee insurability. The uninsurability rate is 23% in the 60s and 45% when you hit 70s. Unless you don't need long-term care, the payout should more than compensate what you put in as premium. Medicare provides only medically necessary treatment and very limited long-term care. Medicaid helps low-income Americans with disabilities, providing them with critical services in order to stay independent and live longer. Currently, Medicaid covers 50% of the country's long-term care expenses. Medicaid services. Medicaid provides assistance with ADL activities such as eating and bathing, IADL activities such as preparing meals, managing medication, and housekeeping. It also supports programs such as nursing home, adult daycare programs, home health aid, personal care services, and transportation. Medicaid. It is a joint federal-state program. You can become eligible through categorical qualifiers, being disabled, age over 65, or blind, families with dependent children, or currently receiving SSI. Or you fall under need-based, which is subject to income and resource guidelines from each state. If your income or resource is above the limit, you need to spend it down or give it away. There are two different types of states. Spend down states such as New York, you must provide for your own care by spending down your assets. Income states, give it away. Example, New Jersey. If you're $1 over, you don't qualify. Income and resource levels. Since Medicaid is designed to help low-income Americans, the income and resource limits are stringent but adjusted for size of household. For example, in New York, monthly income for one person is about $800 and for two is $1,002. Total resource limit is only about $15,000 for one and $22,000 for two. Spousal impoverishment provisions. A certain amount of the couple's combined resources is protected for the spouse. That portion is usually 1/2 of the couple's combined assets, up to a maximum of $119,220 in 2016. Maintenance expense is about $2,002 and housing $600. Spousal income support calculation. If applicant has additional spend down income, it can be passed to the spouse to increase the spouse's income up to the max allowed by the state. Assuming the spouse's income after medical expense is $1,760, max allowed is $2,981, the other spouse can pass another $1,221 to move the income to the max. Non-exempt assets. These are resources that need to be counted for Medicaid qualification. Checking savings accounts, stocks, bonds, CDs, real property except primary residence, additional vehicle if more than one. Exempt assets or non-countable assets. These will not be counted for Medicaid qualification. Primary residence up to a certain value, burial fund, one automobile used by the applicant, personal property and household belongings, qualifying annuities, life insurance policies, asset held in trust. Ways to spend down assets: paying down debt and mortgage, updating, furnishing, and making repairs to house, upgrade house to exclusion value, purchases of exempt assets such as computer or maybe upgraded car, prepaid burial fund, purchase qualifying annuities, converting assets into income. Acceptable transfers. All transfer of assets must follow a 5-year look-back period in order to avoid penalty. Exceptions: transfers between spouses, transfers to a blind or disabled child, transfer to a trust to benefit a blind or disabled child or disabled individual under 65. How do you calculate your spend down income? You start with your monthly income, countable only, subtract out all relevant medical expenses. Once you've accumulated enough bills greater than your allowed income, Medicaid will pick up the rest. Note, the actual calculation is performed over a 6-month period. Income cap states. There are 23 states, such as New Jersey, Florida, Texas. If your income exceeds the state limit, you need to put the excess in the Miller Trust. The trust pays a small monthly allowance to the applicant and the dependent spouse. Extra is used to pay for care. Medicaid can recover money left in the trust for cost of care. Medicaid transfer disqualification. There's a 5-year look-back period. The penalty period is determined by dividing the amount of transfer by the average private pay cost per nursing home in the applicant state. Example, Joe gives away $100,000 2 years before filing. Nursing home costs $5,000. Disqualification period, 20 months. Medicaid estate recovery. In order to recover costs, Medicaid is allowed to seek money from your state, but it must not exceed the amount spent by Medicaid. Sometimes the state might waive recovery when it's not cost-effective. Life insurance with long-term care benefit. It is popular because of its flexibility. If you don't need it, your heir can collect. You can either buy a chronic illness rider which pays 2% monthly death benefit, or a plan that targets 2 to 4 years of benefit. It is a form of self-funding and is more flexible than just buying long-term care. Why is it important to protect assets? To preserve your legacy, to improve your quality of life. Income and assets can provide for additional comforts such as phone, food, and clothes. Pay for medical expenses not covered by long-term care. And finally, make decision points easier for loved ones. Planning for long-term care is complicated and involves a lot of irreversible decisions. Be sure to seek out for a qualified advisor. Wow, that's a lot of learning. Contact us at info@pensionmaxima.com. We are here to help.